Welcome to Cafe Mutual YouTube channel. Friends, over the last few months, equity markets have shown heightened volatility. But what if I tell you about a fund category that takes care of volatility aspect? Yes, in the passive fund space, there is a smart beta strategy that focuses on low volatility. To talk more about this factor, today we have invited Arun Sundaresan, head ETF Nippon India Mutual Fund. Arun has over 2 decades of experience in product management, sales, and distribution. So let us invite Arun. Welcome to the show, Arun.
Thank you, Nishant. Pleasure being in the show.
Okay. So, Arun, my first question to you is that many distributors do not recommend smart beta funds as they feel it undermines their role in identifying suitable funds for investors. So, how do you view this concern?
See, Nishant, I'll come to the smart beta bit slightly later.
Mhm.
But when you talk about passives itself and compare that with active funds, I think your question is something around that, saying why should they recommend passive funds? And within that smart beta, see,
Mhm.
I'll tell you, except for the last leg when it comes to active fund management, where there is an involvement of a fund manager, where he picks up stocks, identifies which sector, when to do, what to do, etc. Except that leg, everything else is same even for passive funds, whether you talk about ETF or index funds, right?
Mhm.
Now, the fact that how much allocation, the asset allocation itself, how much to give an equity, debt, gold, silver, that's a big decision to be made. So if you decide so much in equity, should I give in broad-based markets like Nifty, mid cap, or should I give some thematic, sectoral fund, so on and so forth? These are all big decisions to be made given the risk return appetite, given the circumstances of the client, as well as the market context. So there is tremendous value to be added by partners by recommending passives as such. The only missing leg is the last part where there is a fund management, where is the active fund management involved. Except for that, everything else is similar. Like for example, in today's market context, like let's say last 6 months, had you recommended banking instead of IT, there would have been a 25% difference.
Mhm.
Mid caps and small caps relatively underperformed. Had you said that, okay, let's look at large cap instead, there is a big, value addition that you would have done. So the active passive is just a means, a small means to taking exposure. That's the larger picture. And within that, smart beta again is a very good variant. Within passives, within index funds, for example, the smart beta products themselves have the potential to generate alpha when compared to the broader market. And there again, you can explain a whole lot of things. What are they? What are they trying to do? How do they fit in? How can they add value to your portfolio, etc. So within passives, there is an added element of, if I can call it, value addition that partners can give by recommending smart beta products.
Great. So, what was the rationale behind launching a Nippon India Nifty 500 low volatility index fund? And can you explain a bit about underlying index as well?
So the new fund offer is called Nippon India Nifty 500 Low Volatility 50 Index Fund. So
Yes.
this is the index fund format.
Mm-hmm.
And like the name itself suggests, the basic premise of the fund is to identify 50 stocks from the universe of Nifty 500. It's going to pick 50 stocks from Nifty 500 based on just one parameter, which is low volatility. So the method, it considers the last 1 year data. So every June and December, the last 1 year data of the entire Nifty 500 universe will be considered. Whichever stocks are having least volatility, least standard deviation in terms of price movement,
Mm-hmm.
they make the cut. They become the portfolio. The weight, the actual weight of the stocks will be determined by a combination of this low volatility score as well as free float market cap. So the selection is based on low volatility. 50 stocks get selected, and then the actual weight will be a combination of that factor multiplied by free float market cap.
Got it.
Now, what it does, and where does it sit in your portfolio? The concept sounds very simple, right? You're looking at just one parameter and you're considering low standard deviation or low volatility. But it's a very powerful concept to identify stocks based on consistency or low volatility. It's a very powerful concept. Not very intuitive, but if you think about it, let's say there is a particular stock, let's say it is 100 and it undergoes a 10% correction. So 100 becomes 90, right? Now, on the way up after falling, even if it rises another 11.1%, it will be back to 100, right? Now, consider another stock which is more volatile. Let's say that, 100, it fell by 25%. So
Okay.
100 became 75, and 75 to come back to 100, it has to move by almost 34%, which is a much bigger rise that it needs to have. Therefore, there is a lot of merit in not just rising fast, but also falling less. So in
Hmm.
a combination, when something falls less, even though it rises a little less when compared to other stocks, if you do that consistently, eventually you might come out to be a winner.
Hmm.
So that's the concept of low volatility, and it's worked out very well. In some ways, it's like the tortoise, hare race. You do something consistently, slow and steady. Eventually, you win the race. Something like that.
Great, great, great. So, Arun, all equity funds come with the risk of volatility. While low volatility may reduce fluctuation in the investment portfolio, as you rightly mentioned, it doesn't eliminate the risk itself. So, in this context, why do you believe that the low volatility factor is important for investors?
A fantastic question. So obviously, this is an equity product. All said and done, this is a variation. This is a subclass of equity, right? A smart beta variant, right? So end of the day, you will have all the risk and return of equity asset class in itself.
Hmm.
Now, within that, the entire thing is about the spectrum of risk and return, the relative risk return scope. For example, if I were to say, like, for example, between a large cap and a small cap, everybody understands that small cap has higher return potential, but at the same time, it entails higher risk,
Right.
right? Both are equity products. Somebody could prefer a large cap, somebody could prefer a mid cap, small cap, just to give you an example. Similarly, this low volatility product is a variant, it's a variation on the equity market, which will offer a slightly different risk return profile. So you need to look at that. Within equity, can I look at a product which can give me reasonably good return, at the same time be relatively less volatile, which means that the return profile is going to be relatively more consistent. I prefer that kind of a product than a product which goes up and comes down, has significant drawdown. So I do not want within equity to take that kind of risk, but let me take relatively less risk at the same time generate reasonable returns. So one needs to look at it from a relative sense, but you're absolutely right. Equity risk cannot be taken away, right? It's within that. How do you play equity?
Hmm.
Some products are inherently more aggressive. Some products will be relatively more consistent. The choice will be up to the investors to make.
Great. So, Arun, so I was looking at the index. So, currently and historically, the low volatility index has a high exposure to financial stocks. So, doesn't this increase the concentration risk in the overall portfolio?
So Nishant, so any smart beta product, including this particular product,
Mhm.
one should not go only with the current portfolio.
Mm.
The reason why I'm saying this is that the portfolios tend to undergo significant change. And
Mm.
in this case, every 6 months. So
Mm.
rebalancing period is every 6 months, so twice in a year. So
Mm.
based on that, whichever stocks are low volatile, it does not even look at sectors. Sector is an aggregation, it's an outcome. Whichever stocks are low volatile, relatively least volatile, though those stocks come into the portfolio, right? So today, incidentally, it is those financial services stocks. In the next rebalance, it can be something else.
Mm.
So one should not go with only the current portfolio. It's a very inherent nature of particularly the smart beta categories where every rebalance time, the portfolio could undergo significant changes. The portfolio tends to be quite dynamic in terms of whether it is large cap, mid cap, small cap exposure, or in terms of the outcome of how the different sectors pan out. So one needs to primarily take a decision based on the concept. In this case, you're going with the concept of identifying stocks based on least volatility. And historically, there is a lot of backtesting data. You can check for yourself how this has worked over a period of time in different market circumstances. You can look at something like rolling return, drawdowns, for example, and then compare it with some other strategies and see for yourself the comfort that you could have. And if it suits your requirements, you need to go by that and not necessarily based on the current portfolio.
So one last question, Arun. Historically, the low volatility factor has delivered returns in line with the broader market indices, but it has generally underperformed factors like alpha, momentum, and quality. Then why should distributors consider recommending this index fund to their clients?
Actually, Nishant, we did back testing. So this index data is available for last 20 years,
Hmm.
starting from 2005 till 2025. Even though this fund is new, the
Hmm.
index data based on this methodology, if you have done this for the last 20 years, how the return looked like. Okay. Now, last 20 years, if you look at 3-year rolling return, at any point in time, if investor had invested and looked at 3-year return, how did the average 3-year return look like for the last 20 years? So
Hmm.
that number as of March for this particular fund stands at 15.9%. I
Okay.
repeat, 15.9%.
Hmm.
Now, compare this with Nifty 50 or Nifty 500. Nifty 50, that number is 12.4.
Hmm.
So where is 15.9? Where is 12.4?
Hmm.
Nifty 500 is 12.7. So therefore, there is a substantial outperformance when compared to the broader market like
Hmm.
Nifty 50 or Nifty 500. In fact, you'll be surprised that even when compared to mid caps and small caps, mid cap, for example, the 3-year rolling return was something like 15.8, and
Hmm.
small cap, that return was 13.4.
Hmm.
So both when compared to even mid cap and small cap, this has generated much better return. Now, intuitively, we also talked about it in our earlier query that small cap generally you would associate with higher returns over
Hmm.
a period of time. But no, small cap are actually given 13.4% on a 3-year rolling basis, whereas low volatility, a simple concept, this is given something like 15.9%. So return, at least based on the past return, the returns are actually quite good, much better than the broader market, including the mid caps and small caps. So that's main point. The second thing is the risk adjusted return. So again, during the last 20 years, you compare return, also compare the standard deviation, how the returns are panned out over a period of time. You divide the return by risk, which becomes risk-adjusted return,
Hmm.
return over standard deviation.
Hmm.
That number for this particular fund is 2.6.
Hmm.
Higher the number, the better. So
Hmm.
higher you're getting for every unit of risk, 2.6% of return. That's the meaning.
Hmm.
This number for the market for something like Nifty 500 or Nifty 50 is something like 1.7. So
Hmm.
when compared with broader market, not only is the return better, but risk-adjusted return is also very good.
Hmm.
And this number for small cap is 1. So what it means is that when compared to small cap on a risk-adjusted basis, this is 2.6 times better, right? That's the meaning. So both in terms of returns as well as in terms of risk-adjusted return, at least based on past return profile, they seem to have delivered very good profile. And we don't know about the future, but at least based on the past data, one can draw a lot of comfort from a concept as simple as this. Out of Nifty 500, you're just identifying 50 stocks. Of course, there are some nuances, some finer details, but broadly, that's what you're trying to do. Pick up 50 stocks based on low volatility, let it work wherever low volatility plays out across large, mid, and small cap. So it becomes a good a kind of a flexi cap offering across market cap, and it will keep changing over a period of time. And the return profile seems to be quite encouraging.
Yes, so all right, we have come to an end to this interesting session. Thank you so much, Arun, for your valuable time and inputs.
Thank you very much, Nishant.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.